Two undervalued stocks to consider for February of 2024. This is a series that I've been doing, two undervalued stocks to consider, where I talk about cheaper stocks. Some of them look like value traps, but they do have massive upside potential, mostly over the short to medium term. Then I started doing two other videos. One of them is two undervalued dividend stocks, and the third one I started recently, which is two quality stocks trading at fair value. Many of you enjoyed them. Now, January, I have to say, it has been a pretty good month for my personal portfolio, and for some of the stocks that I talked about on YouTube. This is a stock that I mentioned in my dividend undervalued to consider, which is Decisive Dividend. It's up over 22% over the months. I mean, the stock was just so cheap, trading at 10 times free cash flow, yielding a 6% dividend, and the free cash flow is growing 37-38% a year. I mean, it was incredibly cheap, and I still think it's very, very cheap. The second one was LVMH. I talked about it in my two quality stocks. They pretty much destroyed earnings, growing double digits organically. It's been pretty good. It's up pretty close to 15% since I talked about it in my video. So far so good for 2024, and I hope to get more of these stocks for you guys, even though it's becoming harder and harder to find them in the market with the S&P sitting, at all-time high. We have recently reversed a little bit, but I do have two undervalued stocks for this video. I really hope you enjoy it. If you do, just all I ask, if you could support me by pressing the like button and maybe leave a nice or a bad comment or whatever you want. Just let me know in the comments below. All right. Now, the first one, which I believe is an undervalued stock for February of 2024, is PFE, which is Pfizer stock. Now, this is a stock I did a few videos on, and it kept making new 52-week lows. Now it's sitting at $27 per share, pretty close to a level it was trading at in March 2020. So this is a very low level for something like Pfizer. They recently reported earnings, and the earnings were not bad at all. But normally, whenever you have such a bad chart, it looks horrible, right? Very, very bad. You normally need some kind of a catalyst or something that could potentially change the sentiment, or something that would make you feel more comfortable to invest in it, because you will always keep doubting yourself. Why is the stock going down? Maybe the market is right. Maybe I missed something. And this is what we tend to think about. And this is when these stocks tend to bottom, like Meta bottomed, like PayPal, I believe, bottomed, and many other ones bottomed. Now, I like to look at some kind of insider ownership or what the CEO is doing. And the CEO did an interview with Barron's, which most of you are familiar with, and he pretty much said, all my pension I put into Pfizer stock, I'm all in. And it's over $10 million. And this is not long ago, like January 13, January 14. So recently, the CEO himself is bullish on Pfizer. He's putting his pension into the stock, and he's been buying it. So this to me sounds something that could potentially be marking some kind of a bottom, that the CEO is bullish on the company. It would make me feel more comfortable if I want to own Pfizer stock. This is not the main reason, of course, but if the CEO is betting his pension on the stock at $27 per share at a March 2020 low, that would give me some kind of confidence that maybe the market is wrong. Maybe the market is missing something, and will take some time for the market to realize its mistake. And once it does, Pfizer could go up 20-30% within a few months once you have a sentiment change with these stocks. I've seen it so many times before. But in terms of Pfizer, why did I choose Pfizer? Why not BMY, which is Bristol Myers, is trading like, I think, 8 times earnings or something crazy? I talked about it in one of my videos. Well, I am not an expert on pharmaceuticals, and I'm still studying Bristol Myers, and I'm studying Pfizer, and so far, I see a better pipeline in terms of Pfizer than BMY. BMY's pipeline, I saw, it's a little bit weaker, even though it's less expensive. But as I'm not too experienced with pharmaceutical stocks, I decided to go with Pfizer. But I'm still looking at BMY, and there's over $45 billion of potential revenues by 2030 from many of the different pipelines that Pfizer has and is working on. In terms of guidance, they put up 205 to 225, which is a little bit lower than what was expected, mainly because Seagen is going to impact them. I believe 40 cents per share. They just acquired Seagen. It's still unprofitable. It's not expected to be profitable before 2026, I believe. So but it's growing rapidly, so it's going to get revenue growth, but not much in profits. But around 205 to 225. Which in my opinion was not too bad at all from 184 in 2023. Now, if you use the 205 to 225, if you use the midpoint, the stock is now trading around 12 times earnings, which is lower than the mean of 13 times earnings. So from this thing, we can see that the company is not overpriced by any means. It doesn't seem extremely underpriced, but I'm going to tell you why I believe it's underpriced in a second. but around 12 times earnings. I don't think this is expensive at all. But the main thing was Pfizer. I mean, if you look at this chart, you would say, oh, the company is declining in EPS, declining in revenues. Yes, it used to decline in EPS. It used to decline in revenues. But now this is changing. The trend is shifting from a negative 72% in EPS to an up to positive 20%. And 2025 is expected to be positive 24% EPS growth. So the company is shifting from, declining stuff from the COVID vaccines. Now the COVID vaccines are over. This is a new year, a new page. And they are going to grow again. They've been growing a little bit in Q4, and they expect to grow again in 2024 and potentially in 2025. But the stock chart is not adjusting to it. It's like it's going to keep declining forever and the stock keeps going down, which again gives me an opportunity that maybe the market is missing something with Pfizer. I see the CEO going all in. I see an inflection point where the company is going to go from declining EPS to positive EPS growth, and it's like nothing is happening and the stock keeps going down. So I find this very, very interesting, and I'm interested in this company very, very much. In terms of the dividend, it's around 6%. Now, I have to say, this is something I'm not sure of. I am not sure if Pfizer is going to cut the dividend or not, because, it has been sustaining its dividend since 2011, but they did cut it in 2009 and in 2010. And a lot of shareholders, I've seen them, they complain on the Yahoo message board that the management doesn't really care about shareholders. Now, I'm not sure about that because the company did some buybacks before. They did, pay out a pretty decent dividend. But now the dividend yield is over 6%. And once I see a chart like that, this is pretty much the market saying that the 6% dividend yield is not sustainable. And this is the only thing I'm not sure of in the video, because I looked at how much they're paying in dividends. This is around $9 billion of dividends. This is how much they pay. But in terms of the free cash flow, and I'm not sure why, it's expected to be only $7 billion for 2024. Maybe because of some Seagen-related costs and a few other things, but it's expected to be $7 billion for 2024 and rebound to $16 billion by 2025. Now, in terms of $7 billion, it does not cover the dividend, which is $9 billion. But the company does have around $23 billion of cash. And they have some debt also, of course. But they do have around $23 billion of cash. So if Pfizer was serious about keeping the dividend, they can afford to keep it. But I'm not sure what the management would do. Would the management cut the dividend or would they keep it? And the way the dividend yield has been rising is pretty much the market saying that Pfizer is going to cut the dividend. And this is the only risk that I'm not sure of for the video. I can't really predict what's going to happen. But if I was the management, I would honestly just cut the dividend and move on. Cut dividend and do buybacks. The company now cannot do buybacks because they have the dividend and they have Seagen losing them some money, and now they have some debt. The debt right now, net debt, is around $19.9 billion. They have, I believe, like $48 billion of debt and like $23 billion of cash or something like that. So it's around $20 billion of net debt. This is deducting cash, of course. Now, this is a lot of debt and they pay a lot of interest on it. And Pfizer has their hands full. This is why they can't buy back any stock. One of the reasons why the stock is going down. If Pfizer could do some buybacks and take advantage of these historical low levels, that would be massive value creation for long-term shareholders. But Pfizer can't do it because they have the dividend and they have the debt obligations and they have Seagen losing them money for a while. And a few other things, CapEx stuff, they're working on new pipeline products to replace the expiring patents. And they have a lot of things going on. So the dividend is the only thing I'm not sure of. But it's not the main value proposition. I see the dividend. If they want to sustain it, I would say it's safe for now, unless the management change their mind and we can't predict it. But I see a company trading at a below average multiple. I see a company going from a declining, EPS to growing 20% EPS for 2024 and another 24% potentially for 2025. So this is over a 45 to 50% EPS growth over the next 2 years, trading at a discount, paying a 6% dividend, trading at a chart like that where the CEO is bullish on the company, putting $10 million in the company. To me, Pfizer is a pretty undervalued stock. I would have never talked about Pfizer if the S&P was sitting at 4,000 or 3,800. But relative to other opportunities in the market, this is the only stock that I pretty much found along with the other one. It's not the best option, but I think Pfizer is undervalued at this level. And of course, this is outside of any major lawsuit from any COVID vaccines or anything that happens with the elections. We can't really, predict it. No one can predict it. It could be good, it could be bad. The second stock is a stock that's a little bit riskier than Pfizer, but I believe it has higher upside potential. It's a stock that Monish Pabrai used to own. I made one video on it, and this is more my kind of a stock, trading in a dying industry or a dying company, people believe. But this dying company still has some juice in it, and then once you have anything positive that goes for it, it could cause massive moves in a very short amount of time. And this is a company that's called eBay, and it's trading at $41 per share. Now, most of you would see eBay, you would tell me, oh, no one uses eBay anymore. eBay is a dying company. The same thing people say about a lot of the stocks that I talk about, or about any stocks that say, oh, it's a dying company. Well, it's obvious. This is why the stock is priced as this multiple. But when you have a stock that's priced in on the worst case scenario, and anything positive goes for it, they beat on earnings, something happens, some new innovation, AI or whatever, it could cause massive change in sentiment. eBay could go up 20-30% within weeks, if not within months. And I've seen it many times, and I've experienced these returns. This is pretty much my most profitable investment strategy ever, and I talked about it before. And it's mainly buying stocks with bad sentiment that people hate. You just get an ick whenever you see them. You don't want to touch it. But it's priced this way, and it's priced on the worst case scenario. And anything positive that goes for it can be very rewarding. Just like I talked about Dropbox last year. Dropbox is up over 45%. Since I talked about it at $20. And people kept telling me, no one uses Dropbox anymore. Dropbox is dying. Everyone uses Google Drive. But Dropbox was priced so low that it's insane. It's insane for the margins. And eventually something positive went for it on earnings. The market realized it, and the stock went up. It made massive moves in a very short amount of time. So eBay reminds me of Dropbox a little bit. But in terms of eBay, yes, it's a dying company. It's not growing at all. But you don't need the company to grow to make money. This is not the only way to make money in the market, is by the company growing EPS. It's the best way, of course, for long-term investors. But you could have multiple expansions. You could have a shareholders yield, buyback yield, kind of like what Buffett tried to buy recently. What he did was HPQs, and he sold it. HPQ was not growing, but it had a high shareholder yield in terms of buybacks and dividends. So there's many different ways to make money with a stock. So you don't have to have EPS growing. If it's flat, I'm fine with eBay if free cash flow is flat. But in terms of GMV, gross merchandise volume, it's over $18 billion. I mean, this is still pretty significant, in my opinion, all around the world. But the company failed to monetize it. $2.5 billion of revenues, 26.4% operating margins, over 16 million users. I mean, this is not bad at all. eBay has been lagging in innovation, and just people don't really use it too much. They use more Facebook Marketplace. I agree with you. Maybe they buy cheap stuff on Temu. And I agree with you. All that stuff are massive, massive threats. But eBay is trying. I mean, they did something pretty innovative, in my opinion. And this is mainly you just click on create a listing, and then you go and you take a picture of whatever you want to sell. Let's say you want to sell a mouse, or you want to sell a TV remote, and you take a picture of the TV remote. AI is gonna write the description for you. It's gonna put the price based off what eBay is on them selling for on eBay, and they're gonna give you the image, they're gonna give you the brand, they're gonna give you everything, and you just click list and you sell your item within one picture. I mean, this is some kind of innovation that eBay is doing. I think this is pretty smart, and they're trying. I mean, they're trying. And this is something that you want with these companies. But if I want to buy eBay, or my bet on eBay here in a video, and the same thing with Pfizer, whenever I talk about these two undervalued stocks with bad sentiment, they are not mainly long-term investments. Now, you could hold them for the long term, of course, but this is mainly buying something below fair value. The market changes its mind, the bad sentiment becomes good sentiment, then you sell it 20-30% within a few months, and you move on to the next one. And this is what I've been doing for years. And I recently slowed down, but been doing more long-term stuff. But this is the thing with eBay, that by the time Facebook Marketplace puts eBay out of business, by the time Temu puts eBay out of business, if I bought eBay today, I would likely be out. I mean, this is how I think about these companies. Now, in terms of, guidance in general, or the last quarter, it wasn't bad at all. They had 17.6 to 18 billion in revenues. In GMV, they got to 18 billion of GMV, the higher end of guidance. Revenues, they had got the higher end of revenues. Non-GAAP operating margins, they got to the higher end of it. And they did beat on EPS. Maximum was $1.01. They got $1.03, 3% growth. Not bad at all. So again, this is just, the numbers are not showing me that eBay is dying like people are claiming. It's not growing, but it is not dying. It is not declining in GMV massively. It's not declining in revenues massively. It's still growing. And they have something recently that's been doing well for them. It's mainly called advertising revenues, kind of what Amazon does on the app. Whenever you're selling on Amazon, you want your listing to show up first or second on the search. eBay started to monetize it very well recently, and you could see the massive bump in growth from 275. Now it's around 366 from Q2 of 2022. This is for Q3 of 2023. So this is good. eBay is trying to innovate, is trying to do stuff, and they still have 18 billion in GMV, and they just have to learn how to monetize it. They have to learn how to advertise themselves a little bit better. And this is the main thing with eBay. Now, in terms of free cash flow is expected to grow from around $2 billion in 2023 to around 2.5 by 2027. Now, this is great, but I don't need eBay to grow free cash flow for me to make money. If eBay can just stay flat, it just remains flat on free cash flow. It doesn't grow, it doesn't decline, it just remains the same. This is enough for me to bet on a change in sentiment, or to bet on something I'm going to tell you recently with eBay, which is mainly the share repurchases. eBay, as you can see in the graph, has been repurchasing shares rapidly, sometimes 8% of the market cap, sometimes 10 to 15% of the market cap. It's been huge. And I believe over the long term, if eBay keeps doing that, it's eventually going to create massive value for shareholders, especially if they keep doing the innovation stuff, keep trying to do something. The way the stock is priced in, it's priced at a 9% free cash flow. So if the free cash flow doesn't go up and down, if the valuation doesn't go lower, you're going to get around 9% a year holding eBay in terms of a shareholder's yield. But you still have a potential multiple expansion where eBay is trading around 9.4 times earnings. Now, this is a company with 24% net margins. That's still somewhat growing. It's not growing rapidly, but it's still growing 2, 3, 4%. And it's the way it's priced in for me. It's priced in on somewhat of a worst case scenario. Trading at 9.5 times earnings, everyone's saying eBay is dead, 9% free cash flow yield that's expected to grow, and massive buybacks. eBay is priced like it's never gonna grow. And if it does surprise and it does grow, or it does something, the stock could revert back to the mean of 14 times earnings. This is where eBay used to trade at, because they have pretty decent margins. You trade around 14 times earnings, now sitting at 9.5. Was as high as 34 times and as low at 8.7. So it's much closer to the lows than the high. And for me, eBay is priced like nothing is going to happen, but you still have the 9% free cash flow yield. It's likely sustainable, it's going to grow. And you still have more of a call option. If they do something, the market changes its mind and the sentiment changes, and this could cause a massive move to the upside. But if not, you will likely get 8 to 9% a year. So this is a pretty good asymmetrical bet for me. I think this is why Monish Pabrai initially bought it, and then he sold it and he bought something else with it. I'm not sure, I'm not remember what it was, some coal stocks or whatever it was. But for me, personally, looking at eBay, this is my kind of a stock. I think eBay is undervalued, and I'm still researching it, but this is how I think about it. Yes, there's competition and everything, but if we're right on eBay, and if free cash flow doesn't grow, if it just stays flat, we don't need it to grow. If it just stays flat, eBay could return, in my opinion, massive upside potential. And again, it was not the best stocks you're used to, but it's very hard to find them. I have more micro-cap stocks and small caps that they are too small to share on YouTube, and I talk about them in my own investment group. If you're interested in joining, the link in the description. So thank you for watching the video. It was not financial advice. I hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.